Well, folks, pull up a chair. I'm an old fellow now, 94 years young, and I've seen a few things come and go in the market over the decades. Sometimes I got it right, sometimes I sure didn't. The truth is, investing ain't rocket science, but it's not always easy either, especially when your own human nature gets in the way. I remember back in 1993, I made one of my biggest mistakes, one that still makes me groan a little when I think about it. It was a company called Dexter Shoe. Now, what a bonehead move that was, even for someone who'd been at this investing game for more than half a century. We acquired Dexter Shoe for $433 million. Sounds like a lot, doesn't it? But here's the kicker. I didn't pay for it with cash. I paid for it entirely with Berkshire Hathaway stock, specifically 25,203 shares of Berkshire Hathaway Class A stock. At the time, those shares were trading for about $17,180 a piece. The deal looked okay on paper, a decent price for a shoe company that seemed to have a stable position. I thought I understood the business, thought there was a good chance it would keep chugging along. I was dead wrong. The problem was the company was on the verge of being eaten alive by imports. It had no sustainable competitive advantage, no moat around its business to protect it from competition. It was a low-cost producer at a time when even lower-cost producers were emerging overseas. I was too dumb to see clearly then. The business deteriorated rapidly, and within a few years, Dexter was worthless. We shut it down. Poof. $33 million gone. But that's not the whole story, not the real mistake. The real tragedy, the one that truly gnaws at you, is what those 203 shares of Berkshire Hathaway stock would be worth today. Those shares were the lifeblood of Berkshire, the capital that we could have allocated to truly wonderful businesses. If you held on to those shares, they would be worth many, many billions of dollars now, perhaps over $100 billion, by using our precious Berkshire stock to buy a lousy business. I diluted our shareholders' value in a profound way. It was an unforced error, a self-inflicted wound. Charlie Munger, my partner, he'd probably just shake his head and say, Warren, you paid a very high price to learn that lesson. And he'd be right. Here's what I learned from that mistake, the hard, expensive way. First, never use wonderful currency like Berkshire Hathaway stock, which we believe to be truly valuable, to buy a mediocre business. It's like exchanging gold for sand. Second, always focus on businesses with a durable competitive advantage, a wide moat that protects them from their rivals. Dexter Shoe had no moat. It was a castle with crumbling walls, and I simply didn't see it clearly enough. It was a commodity business, pure and simple, and those are often brutal places to put your capital. My old professor, Ben Graham, he taught me the concept of margin of safety, buying a dollar for 50 cents. That's still the bedrock. But Phil Fisher, he showed me the importance of understanding the qualitative aspects of a business, the management, and whether it had that special something. With Dexter, I might have thought I was getting a dollar for 70 cents, but it turned out the dollar wasn't worth a dollar at all. It was more like 80 cents of quickly depreciating junk. You've got to combine both concepts. It's not enough to be cheap. It has to be a good business too. You know, investing is a lot like baseball. You don't have to swing at every pitch. You can stand there, watch a lot of pitches go by, and only swing when you get one right in your sweet spot. The market will throw you plenty of pitches. Most of them aren't worth swinging at. My mistake with Dexter was swinging at a lousy pitch just because it came by. Charlie always tells me, Warren, remember, the big money is not in the buying or selling, but in the waiting. He's right, of course. Patience is a virtue in this business, a valuable one. This reminds me of when we bought See's Candies back in 1972. Now, that was a truly wonderful business. We paid $25 million for it, which seemed like a lot at the time. The company was making about $2 million pre-tax annually. Charlie was the one who really pushed me on it. I was initially hesitant because the return on invested capital wasn't what I considered spectacular by my usual metrics back then. But Charlie saw the moat. He saw the pricing power, the incredible brand loyalty in California, the emotional connection people had with See's. He said, Warren, think about it. People will pay a little more for a box of See's for their sweetheart because it has that special feeling. It's not just candy, it's a gift of love. And he was absolutely right. Say's Candies now makes over $80 million pre-tax annually without requiring significant capital investment. We probably earned more than $2 billion in cumulative pre-tax profits from that initial 25. That's the power of a wonderful business with a wide moat at a fair price. We've never invested another nickel of capital into it, and it just keeps churning out cash. That's a huge difference from a business like Dexter that constantly needed capital. And then just another time we saw the power of a strong moat was Coca-Cola. We started buying Coca-Cola stock in 1988, eventually investing about $3 billion. People thought it was a mature business, slow growth, but what's more fundamental than a refreshing drink that people around the world enjoy? It's a simple business, easy to understand. It has an incredible brand, a global distribution system, and a taste that people love. The company has paid us increasing dividends year after year, and the value of our initial investment has grown enormously. That's the sort of business you want to own forever. Our favorite holding period is, after all, forever. And then there was American Express. Back in the 1960s, they got caught up in what was called the salad oil scandal. A company they had issued warehouse receipts for, Allied Crude Vegetable Oil Refining, turned out to have tanks full of seawater, not salad oil. American Express was on the hook for hundreds of millions of dollars. Their stock plummeted, and people thought the company was going to go under. While everyone else was panicking, I saw an opportunity. I loaded up on American Express stock. I went to their offices, talked to their employees, went to their restaurants, their travel agencies, and saw that people still trusted the brand. It was a classic be fearful when others are greedy and greedy when others are fearful moment. Ben Graham's margin of safety was staring me in the face. I knew the brand, I knew the business, and I knew its intrinsic value was far greater than what the market was selling it for. We made a lot of money on American Express. It wasn't about fancy analysis. It was about understanding the underlying business and recognizing that human irrationality had presented a bargain. These are the kinds of opportunities that come along when others lose their head. Now, if you're a young investor today, or frankly, any investor, here's some practical wisdom. You don't need to do extraordinary things to get extraordinary results. What you need is patience, discipline, and the ability to think for yourself. My dad, he taught me a lot about integrity and good habits, and those habits apply to investing too. Don't chase hot stocks. Don't get caught up in the daily gyrations of the market. The market is there to serve you, not instruct you. It's a partner who shows up at your door every day, sometimes manic, sometimes depressed, offering you a price for your business. You don't have to deal with them every day. Many folks, they get caught up in the excitement, the daily news, the talking heads on television. They think they need to be constantly doing something, trading in and out. The truth is, that's often a recipe for disaster. I spend 80% of my day reading annual reports, 10Ks, newspapers, trade journals. I just try to understand businesses. And if I don't understand it, I don't invest in it. That's my circle of competence. I don't invest in technology businesses for the most part because I don't really understand how they work or what their future competitive landscape will look like. Now, you might point to Apple. That's a very large position for Berkshire. But I don't think of Apple as a tech stock. I think of it as a consumer product company with incredible brand loyalty and a powerful ecosystem. People love their iPhones. They stand in line for them. That's consumer behavior, I understand. It's like Coca-Cola in a different form. It's about the emotional attachment, the stickiness, the technology inside is important, sure. But what I'm investing in is the power of that consumer connection, the moat around the iPhone. This applies to any business, not just investing in stocks. What really matters in business is finding an enduring advantage, a moat that protects your profits from competitors. It could be a brand, a cost advantage, network effects, or high switching costs. And then you need great managers, people who are honest and talented and passionate about their business. We give our managers at Berkshire a lot of autonomy because we trust them. That's been a cornerstone of our success, finding exceptional people and letting them run their show. But that's not the only lesson I learned the hard way. There's another chapter from my early days that taught me a profound lesson about capital allocation, one that Charlie had to drum into my head. It was about our very own Berkshire Hathaway, the textile company itself. You see, when I took control of Berkshire in the mid-1960s, it was a failing textile mill. I had bought it cheap based on Ben Graham's cigar butt approach, a company so cheap that it had one last puff left in it. I thought I could turn it around. What a fool I was. I kept pouring money into new machinery, trying to make it competitive against lower cost foreign manufacturers. We had great managers, loyal employees, and we tried everything we could. We even tried making specialty fabrics, but it was a dying business, relentlessly battling powerful economic forces that were simply too strong to overcome. I spent years allocating capital to a losing endeavor, capital that could have been deployed to far more productive uses. Incremental returns were miserable, and every dollar I put into those textile mills was a dollar I couldn't put into something wonderful. The biggest mistake was continuing to try and fix it. It was like trying to polish a turd. You can polish it all you want, but it's still a turd. Eventually, in 1985, we finally closed the textile operation. It was a tough decision, one that affected many loyal people, but it was the right financial decision for the rest of Berkshire's shareholders. That experience was incredibly important, perhaps one of the most expensive lessons in capital allocation I ever received. It taught me that it's far better to buy a wonderful company at a fair price than a fair company at a wonderful price, especially if that fair company is stuck in a lousy industry. Charlie Munger really changed my thinking on this. He hammered home the idea that you want to buy great businesses that throw off cash and require little capital, businesses that have pricing power and grow their intrinsic value naturally. My cigar butt approach, while sometimes profitable in small doses, wasn't scalable, and it certainly wasn't a path to building something truly significant. Berkshire Hathaway today is a testament to that shift from a struggling textile mill to a collection of some of the finest businesses in the world, like Geico, See's Candies, BNSF Railway, and more recently, our stake in Apple. It's been a long journey from my days delivering newspapers in Omaha as a kid, saving every penny, to buying my first stock, City Service Preferred, at age 11. I remember when I filed my first tax return at 13, I even deducted my bicycle as a business expense from my paper route earnings. That early instinct to save and invest, it stuck with me. From 1956 to 1969, when I ran the partnership, I was constantly looking for those bargains Ben Graham taught me about, those undervalued situations where the market was simply being irrational. Over at Berkshire, we've always tried to keep things simple. We don't have complicated formulas or fancy algorithms. We just try to understand what a business is really worth, what its intrinsic value is, and then we wait for the price to drop significantly below that value. We're happy to do nothing for long periods of time. In fact, doing nothing is often the smartest thing you can do. It's about letting compounding work its magic. Compound interest is truly the eighth wonder of the world if you let it do its job over decades. My partner Charlie always says, it's not that complicated. He said, you just have to spend a lot of time doing it. He's right, there are no shortcuts. It's about reading, thinking, and having the right temperament. You don't need a super high IQ. I've seen plenty of people with 60 IQs fail spectacularly because they couldn't control their emotions, their fear, and their greed when the market turned. Temperament is far more important than raw intellect in investing. We've had our share of misses too. Dexter Shoe, of course. US Air Preferred stock was another one, a capital-intensive cyclical business I should have known better than to touch. I called it a tar pit because it sucked up cash and never really delivered. And more recently, my investment in Tesco, the British grocery chain, where I misjudged the competitive landscape and management's effectiveness. You learn from every mistake if you're willing to admit them. And trust me, I'm happy to talk about my mistakes. They're often more instructive than the successes. One thing I've never done is use significant borrowed money for my personal investments. That's a sure way to get yourself into trouble when the market inevitably turns south. Margin debt, exotic financial instruments, those are things that can wipe you out no matter how smart you think you are. Rule number one, never lose money. Rule number two, never forget rule number one. Keeping things simple and avoiding debt helps you sleep at night, and that's worth a lot. We've always emphasized a culture of integrity and long-term thinking at Berkshire. My annual letters, which I still write myself, are meant to be a conversation with our shareholders, explaining our hits and misses and sharing our philosophy. Thousands of people come to our annual meeting in Omaha every year, what some folks call Woodstock for capitalists. We had 40,000 people show up one year. It's a chance for them to ask Charlie and me anything, and we try to answer honestly. It's important for shareholders to feel like owners, not just transient traders. My life here in Omaha, it's always been pretty simple. I still live in the house I bought in 1958 for $31,500, drive myself to the office every day. My diet might not be what a doctor would recommend. Plenty of cherry Coke, C's peanut brittle, McDonald's, and Dairy Queen, but it suits me fine. The important thing is that my office, the one I've been in for decades, is filled with books and annual reports, not screens flashing stock prices. My day is about thinking, reading, and occasionally playing a game of bridge with friends like Bill Gates or Charlie. After 94 years of doing this, here's what I know for certain. The investing world will constantly try to tell you it's complex, that you need special knowledge or fancy algorithms to succeed. That's bunk. The truth is, it's really quite simple if you approach it with the right mindset. You don't need to be brilliant. You don't need inside information, and you certainly don't need to predict where the market is going next week or next year. If I could tell young investors one thing, it would be this. Focus on understanding businesses, not just stocks. Think like an owner. Buy a diversified portfolio of good low-cost index funds, and then just hold them for decades. Don't touch them, no matter what the market is doing. The power of compounding over time, especially in a resilient economy like America's, is astonishing. Never bet against America. Look, the biggest returns don't come from brilliant insights, but from enduring common sense. Seek out businesses with durable competitive advantages, understand their economics, buy them at a reasonable price, and then let time do the heavy lifting. Avoid debt, ignore the noise, and cultivate patience. Charlie always says, it is not necessary to do extraordinary things to get extraordinary results. He's right, as usual. Stick to the basics, be disciplined, and you'll do just fine.